welcome to the Insight Sphere. So, today we have a guide for the crypto risk management. So, let's face it, crypto trading is not for the faint hearted. With prices that can soar or crash in minutes, the roller coaster ride can be thrilling and terrifying. That's why mastering risk management isn't just a good idea, it's your lifeline in the volatile world of the digital assets. In fact, looking at the numbers in 2024 alone, crypto investors lost over $10 billion due to the scams, rug pulls, and security breaches, according to chain analysis. And that's not just a random statistics, it's a wake up call. Fast forward to Feb 2025, and the Bybit exchange got hit with a jaw dropping $1.5 billion hack. Clearly, bad things happen when risk is ignored. So, how do you avoid being the next headline? Simple. You build a bulletproof risk management strategy. So, what is the risk management in crypto? Think of it like this: risk management is your GPS in the chaotic jungle of crypto markets. It's the art and science of identifying potential, understanding them, the risks, and building safety nets to minimize losses. Having a solid risk strategy could mean the difference between staying in the game or getting wiped out. So why should you care? Because in crypto, the market doesn't sleep and neither do the risks. A tweet from Elon Musk or sudden regulation in Asia can send prices spiraling, add in high level fear of missing out and emotional trading, and you have got a perfect storm. Risk management helps you cut through the chaos and stay grounded when everything else is panicking. Let's talk about the biggest risks you will face. There are several types of risk in crypto trading, and they can creep in faster than you think. The first one is market volatility. This is the biggest beast you'll wrestle every day. For example, Bitcoin dropped nearly 15% in a single day in March 2024 after an unexpected interest rate hike. Another one is leverage risks. Sounds fun, right? Borrowing money to make more money. But many traders blow up their account because they over leverage without any protection like stop losses. Another one is security risks. From exchange hacks to phishing emails, the digital wild west is full of traps. If your security hygiene is poor, your funds are at risk permanently. Emotional trading, that one is another a hindrance, making decisions based on high panic or boredom. That's the fastest way to destroy a good trading strategy. Don't just survive, thrive, you have to. Core risk management principles are: if you are serious about crypto trading, these are your new commandments. Number one is position sizing. Stick to the 1 to 2% rule. Never risk more than 2% of your capital on a single trade. Got a $5,000 account? That means which trade should only risk $50 to $100. This way, even a string of bad trades wouldn't cripple your portfolio. Number two is use stop loss and take profit orders always. Set up a stop loss to protect your downside and take profit to lock in gains. These tools keep you from making emotional decisions when markets swing. Number three is know your risk reward ratio. Ask yourself this before entering any trade: what's the reward and what's the risk? A good ratio is at least 1 to 2, meaning you risk $1 to make $2. Even with a 50% win rate, you'll stay profitable over time. Number fourth is diversify. Don't put all your funds into one moonshoot altcoin. Mix things up. Spread your investment across sectors, stablecoins, and major assets like BTC and Ethereum. It cushions you from a disaster when one coin tanks. Number five is tame the leverage beast. Sure, leverage looks good on the trading dashboard, but unless you are a pro, keep it below 5x or better yet, don't use it at all. High leverage plus emotional trading is a recipe for liquidation. Ready to level up? Here are some advanced tips. When you have got the basics down, try adding these next level strategies to your arsenal. Tools like RSI, moving averages, MACD aren't just fancy charts. They help you understand momentum, trends, and ideal entry and exit points. This intelligence allows you to place smarter stop losses and more confident take profits. Another way is dollar cost averaging. If you want to invest without stressing about price timing, DCA lets you invest a fixed amount at regular intervals. It's steady, low stress way to build a position over time while neutralizing volatility. Another one is using the average true range. ATR tells you how volatile a coin is. A high ATR expects big swings, so widen your stop loss. For example, if ETH has an ATR of 25, you might place the stop loss to 50 to 75 points, a way to avoid getting stopped out prematurely. Using leverage to futures or margin trading, you'd better know your limits. Stick with isolated margin to protect the rest of your account. Never risk more than a small slice of your capital on any leverage position. So let's break it down with the realistic scenario. So meet Thomas, a new trader with big dreams but no plan. So let's suppose Alex starts with a $5,000 and after seeing Solana surge 15% in a day, he jumps in. Hyped by social media, he goes 10x leverage with a $2,000 position and no stop loss. Classic Rocky move, you think. Then bam, news drops about rising interest rates. Solana dips 12%. Within minutes, Thomas' position hits liquidation. $2,000 gone, or 40% of his entire account. So what went wrong? No stop loss, over leverage, emotionally driven by hype, violated the 1 to 2% capital rule. What should have Thomas done? Use the stop loss, limited leverage to 2x or none, and kept his risk to $50 to $100. One misstep turned a promising trade into a financial facepalm. Don't be like a Thomas. Watch out these common mistakes. Even the best traders make mistakes, but recognize them can save your wallet. Forgetting stop losses, trusting yourself manually, close trades in a 24/7 market. That's not smart. Putting everything into one asset, especially a sketchy meme coin, is asking for trouble. Trading on vibes instead of analysis, that's gambling, not a strategy. Risk management works only if you actually follow it. So here's the final thoughts. Make risk management your superpower. If there's one thing to take away, it's this: risk management isn't a safety net. It's your secret weapon. It keeps your portfolio alive through the dips, the dumps, and the drama. Crypto trading will always carry risk, but with the right mindset, tools, and discipline, you can ride the waves and come out stronger, even if the market throws a storm your way. And make risk management your top priority because profit is meaningless if you can't protect your capital. Want more crypto survival strategies? Stick with the Insight Sphere for powerful insights, real world tactics, and guides to help you win the wild world of crypto. Thank you for watching this video. Please like and subscribe my channel.